This is Nightly Business Report with Bill Griffith and Sue Herrera.
Go away, May. Stocks post their first monthly decline of the year after the White House threatens to impose new tariffs on one of our most important trading partners.
Hitting the brakes, why the auto industry could be a casualty of the Trump administration's new trade fight with Mexico.
Looking for safety, our market monitor has some stock picks he says can weather this latest storm. Those stories and much more tonight on Nightly Business Report for this Friday, May the 31st.
Good evening, everyone, and welcome. Stocks fell sharply, capping a brutal month for the market. Today's declines were driven by trade tensions, not between the U.S. and China, but with Mexico. And that's where we begin tonight. President Trump rattled investors worldwide with a tweet threatening tariffs on Mexican imports beginning June 10th. The tariffs would start at 5%, potentially rising to 25%. The president said they would be in place until illegal immigration across the southern border was stopped. That surprise threat sent stocks sliding. The Dow Jones Industrial Average fell 354 points to fall below 25,000. The Nasdaq was down 114, and the S&P 500 slid 36. Kayla Tausche reports tonight from the White House.
A frustrated President Trump took to Twitter to announce new tariffs on Mexico as a tool to crack down on border crossings. The president pushing forward with this strategy with a green light from the top White House attorney, despite what sources say were objections from his top trade officials, Ambassador Robert Lighthizer and Treasury Secretary Steven Mnuchin. White House trade advisor Peter Navarro suggested Mexico could step up before the tariffs go into effect on June 10th.
I would suggest to investors to look at this calmly. Look at what we're trying to do. This is actually a brilliant move by the president to get Mexico's attention, to get them to help us.
Mexico's President López Obrador says the U.S. shouldn't solve social problems with taxes. And Mexico's foreign minister flew to D.C. for negotiations with U.S. officials. But key lawmakers on Capitol Hill were critical of the move. The Senate Finance Committee Chairman Chuck Grassley called it a misuse of authority and one that would seriously jeopardize passage of the new trade agreement between the U.S., Canada, and Mexico. It could also have broader consequences for U.S. trade relationships.
Basically, Mexico and China compete. When Mexico wins, China loses. When China wins, Mexico loses. China won yesterday, and the one who won the most is President Xi Jinping.
President Trump's February declaration of a national emergency at the southern border has been tied up in a protracted court battle, and a similar challenge could await this order. The U.S. Chamber of Commerce, one of the leading business groups here in the U.S., has said since finding out about these proposed tariffs, it has been working nonstop to explore potential legal options. For Nightly Business Report, I'm Kayla Tausche in Washington.
And there is late word tonight that Secretary of State Mike Pompeo and Mexico's foreign minister will meet in Washington on Wednesday.
Clearly, the U.S. and Mexico have strong economic ties. I mean, it has been one of our largest trading partners for years. Imports from that country totaled $347 billion just last year alone. And the major goods that come across the border include autos, computers, oil, and vegetables.
And that is why shares of Fiat Chrysler, General Motors, and Ford all fell during today's session. 15% of the cars and trucks sold in the U.S. come from Mexico. And if a tariff goes into effect, automakers will be faced with no good choices. Phil LeBeau has more.
When GM decided to build the new Chevy Blazer in Mexico, it seemed like a no-brainer. After all, Mexico has lower labor costs than the U.S., driving strong profit margins for in-demand models like SUVs. But Blazers from south of the border will not be as profitable if GM has to pay 5% for every one it brings into the U.S. So what should the automaker do? President Trump tweeted, "In order not to pay tariffs, if they start rising, companies will leave Mexico, which has taken 30% of the industry, and come back to the USA." Don't expect that to happen. The number of Mexican-made autos imported to the U.S. hit almost 2.7 million last year, almost all coming from multi-billion-dollar plants that have been locked in place for years.
Largely, these decisions predate Donald Trump, and that plant will be in place for 30 or 40 years, so it will long outlive him as well.
So as trains bring millions of cars into the U.S., should automakers simply pay the 5% tax, which would kill profit margins, or do they pass it along to the customer in the form of higher prices, which would hurt sales. And how would car buyers react if prices jump by hundreds of dollars?
I think, for consumers, it's about what their monthly payment is when you think about, their affordability. And so, what they can pass on and what they can, we'll see.
For now, the Auto Industries Trade Association says tariffs would not be good for business. As for individual automakers, they're not commenting specifically about the president's tariff threat. But they've been down this road before with President Trump, and they're hoping that this time the president does not follow through and institute a tariff. Phil LeBeau, Nightly Business Report, Chicago.
And it's not just the automakers. The companies that transport goods across the border, like the railroads and the truckers, they also had a rough day today. The concern there is that a heightened dispute with Mexico could further dampen volumes. They've been already hit by the trade war with China. Frank Holland has that part of the story for us.
85% of the nearly $350 billion in goods imported from Mexico into the U.S. last year came in on trucks and on trains. And those industries expect to see a major impact if new tariffs go into effect on June 10th.
Well, if they're put into place, there's significant negative implications. Mexico, there's about $350 billion of goods that come up north from Mexico into the U.S. Most of that gets put on a rail or a truck. And so the implications for the transportation sector vis-a-vis freight flows, frankly, are extremely negative.
The biggest impact today seen in rails that operate on the West Coast. Kansas City Southern has a large operation in Mexico. Citibank says about 16% of its revenues could be at risk. Union Pacific says about 5.5% of its overall volume goes from Mexico to the U.S. And trucking is expected to see the biggest impact.
Trucking rates are directly related to the supply and demand, the daily supply and demand indicators of the trucking industry. And given cross-border Mexico volumes are a significant absorber of capacity, to the extent that volumes are impacted by these tariffs or escalating tariffs, that would be very negative for trucking and trucking rates for sure.
Those rates have fallen 18% since last April. That's largely because of the trade war with China and how it slashed U.S. exports, cutting down the goods that truckers are hauling. Analysts say another set of tariffs could put smaller operators out of business. For Nightly Business Report, I'm Frank Holland.
Following this new tariff threat, some of Wall Street's major banks are reassessing their outlook for interest rates. J.P. Morgan is calling for the Fed to cut rates twice by December. Barclays sees the Fed cutting rates a total of 0.75% by the end of the year.
And Chinese leaders are watching closely to see how this tariff threat with Mexico plays out. Eunice Yoon explains why from Beijing.
Today, the Chinese Foreign Ministry pointed out that President Trump's latest tariff threat on Mexico merely shows that no country is safe from what it described as the U.S.'s bullying policies. The ministry said China is not the only victim. President Trump's latest threat against Mexico helps Beijing push its narrative that China is a stable leader compared to Washington. China is also likely pleased because it had been wary of the USMCA, that the U.S. would use a clause to undermine Beijing's own trade relations with Canada and Mexico. The clause is aimed at limiting ties for the three countries to economies considered non-market. In addition, Mexico has been seen as a winner in the U.S.-China trade war. American companies have been talking about shifting production from here to there with tariffs on Chinese goods so high. As for the trade talks, President Trump's announcement probably won't instill confidence among China's negotiators that a trade deal with the U.S. would stick. A former central bank chief who remains influential here told a seminar in Beijing today that he didn't expect to see any major progress even if Presidents Trump and Xi meet at the G20. Instead, President Trump's threat against Mexico will likely only reaffirm what appears to be China's current strategy, to wait things out. For Nightly Business Report, I'm Eunice Yoon in Beijing.
China may be getting ready to retaliate against the U.S.'s de facto Huawei ban. The government is creating an unreliable entities list of foreign companies and people that it believes interfere with Chinese businesses. The names were not revealed, nor did China say how it would punish those on the list. As you know, tariffs on $60 billion in U.S. goods in retaliation for the higher duties on $200 billion worth of Chinese products will kick in tomorrow.
Well, the U.S.-China trade war may be taking a toll on the Chinese economy. Factory activity in that country has weakened more than expected. The latest government report says that new orders fell in May for the first time in 4 months, and export orders declined for the 12th straight month.
A new report from Deutsche Bank says the trade wars so far have cost the U.S. stock market $5 trillion in foregone equity returns. The report explains that the tariff battle prevented a recovery in global growth and is keeping equities range-bound.
Time to take a look at some of today's upgrades and downgrades. Actually, a couple of upgrades to tell you about. Uber was upgraded to overweight from neutral at Atlantic Equities. The analyst cited an improving competitive landscape in that business. Price target $52. That stock rose 1.5% today to $40.41. And Kraft Heinz was upgraded to neutral from underweight at Piper Jaffray. The analyst says that many risks appear to be priced in that stock already, but he does remain cautious on the company's outlook overall. Price target $31. That stock rose fractionally today to $27.65.
Still ahead, is it time to play defense when investing in this market? Despite concerns over the economy, consumer spending was solid in April. According to the Commerce Department, personal consumption expenditures, a measure of household spending, increased 0.3%. Driving all of that spending was a 0.5% increase in income, the best gain of the year. Both of these figures were better than what economists had been expecting.
And as we mentioned, the three major indexes posted their first monthly declines of 2019, even as volatility indicators spiked. Oil, by the way, fell by 16% in May. That was its biggest monthly decline since November. Mike Santoli's been covering the markets for us from the New York Stock Exchange. You know, how much of a surprise was this sell-off? I mean, the old adage is sell in May and go away.
That's exactly right, Bill. And I do think that, we had one of the strongest 4-month starts to any year in decades through April. The S&P 500 up more than 17%. So I do think some kind of pullback was probably expected by many investors. I do think the intensity of the decline and the fact that really there was no relief along the way. Every week was down. And of course, the tariff news made it about a little bit more than just giving back some gains and having some flat profits for the first half of this year. It became about exactly how the world is going to grow for the rest of this year. And in fact, to me, reflected most in the bond market when you have those treasury yields at multi-year lows just about as the markets sort of brace or perhaps expect the Fed to cut rates in response to all these pressures.
Well, the trade issues are still with us. So what are you hearing? With the trade war still in place, is the selling expected to continue, or do you think we're bottoming out a little bit and maybe ready to bounce?
Yeah, so there are some indicators that say just because it's been so lopsided to the downside in the month of May, perhaps we should be in for some relief. What happens is when the market is under a lot of pressure, 1 out of every 6 stocks in the S&P 500 is below its December low. So there really has been a lot of damage below the surface, and it takes incrementally more bad news to keep the market going lower in that environment. I do think that you should expect some kind of a bounce. Also seasonally, when you've had a weak May after a strong 4-month start to a year, June tends to be a little bit better. 7 out of the last 9 years in that condition, you did get a little bit of a bounce. But I do think it's important to remember the big picture issues are still with us, and I think the market craves some kind of confirmation that the U.S. economy remains resilient to a lot of these threats.
Very quickly, Mike, what do you make of some of these analysts on Wall Street who are suddenly now calling for rate cuts before the end of the year?
It seems these economists are kind of capitulating to the message of the bond market. We have not really heard from Fed voices themselves that they're really moving very fast in the direction of considering rate cuts in the next few months. But it seems that the market action has been so relentless that a lot of these economists are saying, maybe the bond market knows better than we do.
Mike Santoli at the New York Stock Exchange. Have a good weekend, Mike. Thanks.
Thank you, Bill.
After a day, a week, and a month like this, you might be thinking about investing in defensive sectors, which are areas of the market that tend to perform better than the broader market during rough patches. Dominic Chu plays defense for us.
With the Trump administration's decision to pursue a new round of tariffs targeted at Mexico, markets found another reason to move lower. That has put sectors perceived as relatively more stable into the spotlight yet again. Stocks and companies tied to things like utilities and household goods have long been seen as being less exposed to extreme bouts of stock market volatility and relative outperformers in times of market stress.
On the equity side, we do think that we could experience some sort of rebound from these levels, but we don't have the huge or a very high conviction in that. And so as a result, there's nothing wrong with defensive like consumer staples, low volatility, high quality equity. So that's where we're biasing our portfolios.
It seems like a solid game plan in the event of more downside in the markets. But this past week, the utilities sector roughly matched the decline of the broader market, and the consumer staples sector actually fell by more than the market. One reason may lie in the valuations of these more defensive sectors. Both utilities and consumer staples are valued at more than the overall market, meaning traders and investors have to make a decision about whether buying into defensive sectors is worth it, given how much more expensive they are. For Nightly Business Report, I'm Dominic Chu.
And it's time for our weekly market monitor, who says investors need to be more cautious than at any other time since the financial crisis. And he has names of 2 stocks and an exchange-traded fund that he says could help keep your portfolio safe in this environment. We welcome back Phil Blancato, who's CEO of Ladenburg Thalmann's Asset Management Division. Welcome back. Good to see you.
Thank you for having me back.
At times like this is when investors often, if they're going to buy Treasury securities, want to buy those shorter dated maturities. And you've got an exchange-traded fund who does that for them, right?
Yeah, I mean, we've all made a lot of money in the last 10 years. This year, you're still up 10%. So take some profits, raise your cash levels, or put it in JPSD. It's a JP Morgan product, paying over 2.3% yield with a 2-year duration. That means you get your money back real fast, real high-quality income, and it just lets you wait around. In other words, be paid to wait around. That's what you want to do when volatility spikes like this.
You also like Costco. It has a membership fee schedule, and that gives it some recurring revenue, obviously. But you also like it for other things. Why?
Key reason. You think about what we talked about already on the show. Right now, you want to kind of hunker down. And where do you do that? You go focus on the consumer. Why? Consumer is gainfully employed. You mentioned earlier, consumer spending has been pretty robust, and PCE's up a bit, right? So that means the consumer is still active. In that sense, what do they need to buy? Not what they want to buy. What do they need to buy? Costco, at the core of it, where are we going to defend and keep earning money? It's in companies where we're going to need to buy things, and that's Costco.
And the other one's Walmart. You like that one. Is it immune, though, to the tariffs?
This one's a little bit more volatile, but here's what I like about Walmart. They're going through this massive transformation, and I think you can get the company pre the liftoff that's coming. They're the only company that's going to directly compete with Amazon, and they have committed to going to a digital company, and they still got great brand recognition. So you still got that need to go to Walmart. You still got the strong consumer. But at the end, if you can catch this transformation and they get it right, so a bit of a gamble, in the long run, I think you could be paid a nice dividend and get some upside to the stock.
You say next week is going to be critical to the markets because we're going to get some key economic data. We're going to get the jobs report as well. But why do you say that investors need to be as cautious as since 2008? What is it that is that worrisome to you?
The first big worry I have is that can earnings get any better than where they are? Remember, we had last year double-digit earnings growth. This year, they're flat, up 1%. And I'm really concerned that that's going to be the continuation through the rest of this year. So that means for the first time in a long time, we're seeing a real erosion in earnings power. Second, the consumer just may not be strong enough to blast through these tariff issues. They're out there, and they're not going away anytime soon. So for that reason, raise some cash, get conservative, wait around, and see how this all plays out.
Right.
Phil Blancato with Ladenburg Thalmann Asset Management. Always good to see you, Phil. Thanks for joining us. And for more on his picks, you can head to our website at nbr.com.
A big quarter for Big Lots. That's where we begin tonight's market focus. The discount retailer exceeded analysts' earnings expectations. Sales at stores opened at least a year rose, and the company raised its full-year outlook. The stock today jumped more than 6% to $27.60. Specialty retailer Genesco reported better than expected earnings and revenue. The apparel and accessories retailer is now focused on footwear. The CEO said its strong holiday season carried over into the new year. The stock was up more than 11% to $44.98. And Amazon is buying part of the ad tech company Seismic, including its ad server. The company helps personalize ads using data. The deal comes as Amazon tries to take an increasing share of the digital ad market. Today, the stock dropped more than 2% to $1,775.07.
You may have noticed more CBD products available for sale these days. You know, CBD is a cannabis extract that does not contain THC. That's the psychoactive component of the cannabis plant. But CBD has quickly grown into a billion-dollar business, and the FDA is trying to get a better handle on it. So today, the agency held its first public hearing on the matter. Aditi Roy was there in New York for us tonight.
When the Farm Bill passed late last year, hemp was legalized in the U.S. The result was a flood of cannabis-derived products, the most popular of which is CBD, in the form of things like lotions and oils. But today, the FDA's acting commissioner made it clear many hemp-based CBD products must go through FDA approval before they can land on U.S. store shelves. Agency officials heard from company executives, advocacy groups, and researchers. Some retailers like Walgreens and CVS toed the regulatory line, stocking shelves of select stores with less controversial CBD products like topicals and staying away from ingestibles like CBD-infused supplements, food, and beverages, which clearly fall under FDA scrutiny. Others like Walmart and Target have shied away from carrying any CBD products, instead waiting for the FDA to issue regulations, which could include testing requirements, dosage limits, and packaging and labeling guidelines. Former FDA Commissioner Scott Gottlieb says there are a lot of regulatory issues to consider.
It's going to be hard for regulators to differentiate from the CBD that's derived from cannabis versus hemp. And what is derived from cannabis could have high levels of THC in it.
That's not stopping cannabis companies from betting on the U.S. CBD market, which Piper Jaffray estimates could reach $15 billion in the next 5 years. Tilray plans to introduce CBD products in the U.S. by the end of the year. And Canopy Growth will plant hemp in 7 states, including California, Kentucky, and New York. CEO Bruce Linton says there are a myriad of possibilities for future CBD products, including a sports drink.
I'm talking about a beverage when you go to the gym and you drink it, it should have the intention of making it so after the gym, the next day you're less sore. And if it can do that, then we'll all be a bit more fit.
But first, those companies are waiting to hear from the FDA on those regulations. It's unclear how long that will take. In the meantime, the U.S. Hemp Roundtable, an advocacy group, says it's also working with lawmakers to create what it calls a more efficient pathway for CBD products. For Nightly Business Report, I'm Aditi Roy, New York.
And coming up, improving your mood out of all places, the airport.
Here's a look at what to watch next week. On Monday, Apple hosts its Developers Conference, which will focus on the company's latest software for its phones, Macs, and Apple Watches. On Wednesday, the Fed releases its Beige Book, which is an anecdotal look at the economy across the country. On Friday, the job market will be in focus when the government releases its monthly employment report. That is what to watch for next week.
Well, on this tough market day, we thought we would end the show with something a little bit lighter here. It's a story about a business that cares how you feel. And believe it or not, it takes place at one of the nation's busiest airports. Jane Wells takes us to LAX.
Los Angeles International Airport, traditionally nobody's favorite place. The airport now lets you tell it how you really feel, and more on that in a moment. LAX was a gem of commercial aviation a half-century ago, but with a record 87 million plus people passing through here last year, traffic's a mess. So this place is leading a national wave of airport improvement projects with a $14 billion overhaul.
You know, United States is the birthplace of modern aviation, and our airports should be the ones that other airports around the world aspire to be.
By 2023, LAX will have a people mover to reduce traffic, and every terminal is being modernized. So how to pay for all this? Well, the airport's going to take on some debt. It also makes money off its concessions it can use. And on every airplane ticket we buy, there's a small fee for just this sort of thing. Right now it's about $4.50. That fee has not gone up in 19 years, and the airport would like to see it rise.
It has been the same rate for 19 years, and you can imagine the cost of what anything was 19 years ago and what it costs today.
Meantime, have you seen these machines? They're popping up to register happiness in real time. LAX is testing them outside bathrooms, and we're told the monitors are cleaned regularly. The leader in this industry is a company out of Finland called Happy or Not, with 30,000 terminals across the globe and more than 1 billion button pushes so far. Its main investor is Northzone, an original backer of Spotify.
It really has the potential to create a global happiness index, not just airports, but also retail, healthcare, services, hospitality, and many, many more.
You'd think most responses would be negative, right? Wrong.
But what we have learned is that roughly 80% of the people, they are actually leaving good feedback.
And maybe even more surprising, airport customer satisfaction is up. And LAX has risen from 100th place to 69. For Nightly Business Report, Jane Wells, LAX. Before we go, here's a look at the day's numbers on Wall Street. The Dow fell 354 points to fall below 25,000. The Nasdaq was down 114. The S&P 500 slid 36. And May was the worst month for the market so far this year. That does it for Nightly Business Report. I'm Sue Herrera. Thanks for joining us.
I'm Bill Griffith. Push the happy button.
Yes.
The weekend's here. Have a great one. We'll see you Monday.